A 1% fee on your retirement account costs you 28% of your final balance. That is not a miscalculation. It is the documented mathematical result of a system built after 1974. A system most people believe is a benefit. It is designed to feel safe. It is engineered to keep you compliant until it is too late. This system is called the Deferred Compensation Cage. It is not a savings vehicle. It is a risk transfer mechanism. It moves 100% of market liability from your employer to you. It was not designed to make you wealthy. It was designed to make your employer predictable. Today, over 60 million Americans have active 401(k) plans. These accounts hold over $7.3 trillion in assets. The framework for this system was created by the Employee Retirement Income Security Act of 1974. This law allowed employers to stop offering defined benefit pensions. They replaced them with defined contribution plans. Your pension was a promise of income. Your 401(k) is just an account with your name on it. The first layer of the cage is visible. You contribute money from your paycheck. Your employer might offer a match. The money grows tax-deferred. This is a simple and attractive proposition. It is the public-facing design. It is also a profound misdirection. The cage is not the account. The cage is the lack of control. The second layer is where the wealth is siphoned. This is done through a mechanism we call the fee drag. Most 401(k) plans offer a limited menu of mutual funds. These funds have expense ratios and administrative fees. A typical fee is around 1% annually. A low-cost index fund might charge 0.1%. The difference seems insignificant. It is not. The compounding effect is relentless. Two people invest $10,000 per year for 30 years. Both earn an average of 7% annually. One pays 1% in fees. The other pays 0.1%. After 30 years, the low-fee investor has $1.22 million. The high-fee investor has $963,000. They lost over $250,000 to fees. That money is gone. The midpoint revelation is this. The 401(k) was never intended to be your primary retirement plan. It began as a footnote in the Revenue Act of 1978, a tax loophole for executives to defer compensation. It was adapted by benefits consultant Ted Benna in 1980. He realized it could be offered to all employees. Companies saw it as a cheap replacement for expensive pensions. Your retirement is built on a repurposed tax loophole. Capital Dispatch reconstructed this analysis from public financial records, economic research, and documented market data. The escape is not to abandon the system. It is to operate it with precision. This is the parallel asset protocol. Step 1 is to optimize the cage. Log into your 401(k) plan today. Find the complete list of available investment options. Identify the fund with the lowest possible expense ratio. This is usually a broad market index fund. Move 100% of your balance into that single fund. Contribute only enough to get the full employer match. The match is the only true arbitrage in the system. Do not contribute $1 more than the match. Step 2 is to build the lever. Open a self-directed retirement account. A Roth IRA is the most common for American taxpayers. This account is your parallel system. You control the investments. You control the fees. You are no longer limited to your employer's curated menu. This is where your real wealth will be built. It is an asset that is independent of your employer. Step 3 is to convert the surplus. Every dollar you save for retirement above your employer match goes here. It goes into your self-directed account. Inside this account, you can buy low-cost ETFs and index funds. Many have expense ratios below 0.05%. This minimizes the fee drag. It maximizes your compound growth. You are moving capital from a high-cost environment to a low-cost one. The plan they offered you was not designed for your wealth. It was designed to reduce their liability. You were given a tool that you were not taught how to use. The difference between those two realities is your future. Capital Dispatch. Now you know the math.